Chairman of the House Foreign Affairs Committee is recognized.
Well, thank you very much, Mr. Chairman. And Chair Yellen, good to see you. I would like to follow up on a question here about capital. We know on the one hand that over-leveraged institutions are vulnerable to market shocks, and we remember the consequences. If you look back at the over-leveraging of the investment banks for the large ones, 40 to 1, and if you look at the GSEs that were leveraged at that time, over 100 to 1, and that was in the lead-up to the financial crisis. And so we can see that capital standards must play a role in building resilience in the U.S. financial system. On the other hand, raising capital also has a cost to the economy and a cost in terms of what it does to the potential for growth. So what we have here is a classic cost-benefit test. There is a benefit to higher capital standards. They reduce the risk of a future financial crisis and bailouts, as well as potentially increasing tax revenues. And while the costs will be borne by borrowers in the form of higher funding costs and the economy as a whole with less capital formation and a lower GDP, you've got that on the other side of the equation. So, as you've said in the past, a cost-benefit analysis is difficult work. And I agree, it's not easy. But it's not impossible, and it is important. And so, in 2010, the Basel Committee did some work on this subject, and also researchers at George Mason recently published a paper on the benefits and costs of a higher bank leverage ratio. So how do we get to the right number? Should it be 5%, the 10% in the Choice Act, 23.5% as proposed by the Minneapolis Fed president? There's quite a range there. And I don't expect you to say a number today, but can't you agree that a cost-benefit analysis could help us more effectively require that capital? And I'll start with that question.
So I do agree that in deciding on the appropriate level of capital standards, we are weighing costs and benefits, the benefit of a lower probability of a financial crisis that has incredibly high costs against the cost of slightly higher intermediation and borrowing costs. And as you indicated, Basel III was partly informed by the Basel Committee's analysis of those costs and benefits, and the Federal Reserve participated in producing that analysis. And I think it did inform our views as to what a reasonable level of capital requirements would be. The Minneapolis Fed study that you mentioned also contains cost-benefit analysis and draws the line differently.
So from my standpoint, it seems to me that the Fed would be best suited to conduct the analysis and the research on this. And as you're explaining here, we have such a range of opinion, although we agreed on the basic concept here. So my question would be, short of us mandating the Fed do it, would there be a way for you to try to move forward and approximate what that ratio should be?
So there are different aspects of it. As I said, we did do cost-benefit analysis, and it informed our judgments at the time. You've referred several times to a leverage requirement.
Right.
And I think our understanding of the risks facing banks lead us to think that a simple leverage requirement would not be an adequate way to determine capital. In particular, a simple leverage requirement treats the risk associated with the U.S. Treasury and a junk bond identically, and we think that capital requirements need to be risk-sensitive with a leverage ratio.
No, I understand.
As a backup.
And it might not be sufficient, but in terms of having it be a component, it seems to me that, well, there's another question I wanted to ask you too, and that's, yesterday you told Senator Crapo that The goal of bringing private capital back into the mortgage market is important, and that you hope that if there are guarantees in the secondary mortgage market, that they would be recognized as priced appropriately. It's my understanding then that you believe that the pre-GSE model of private gains and public losses did not price the government backstop appropriately.
I think that's correct.
Thank you.
Time of the gentleman has expired.